Hello, I'm Irina Orishkova, your nonprofit auditor, and today is our NAP number 5. NAP stands for Nonprofit Auditor Points. I designed NAPs to have a conversation with nonprofit financial teams about financial and accounting and auditing topics. Hopefully, NAPs do help nonprofits to understand some accounting issues and understand how auditors work with nonprofits through the audit process. Before we start, I want to have a disclaimer that NAPs are not authoritative presentations. NAPs are based on my personal experience as an auditor. I started in a large CPA firm and I moved to the smaller CPA firm, and I've been doing audits as a owner of the small CPA firm in downtown Oakland for many years. Hopefully these NAPs can be useful for all nonprofits. And today in NAP number 5, where we're going to discuss expenses. Expenses are a very important and critical part of financial statements, because expenses appear in 2 types of statements out of 4 statements for nonprofits. And those 2 types are statement of activities or profit and loss statement. We're going to use it interchangeably, and statement of functional expenses. Statement of functional expenses is very unique statements for nonprofit organizations. The fact that these expenses appear in 2 types of statements means that for financial statement presentation, expenses are very critical. And if we think about it, expenses shows the operating and administrative and fundraising overall activity of an organization. Expenses used by a lot of various parties to analyze overall performance of the organization. Expenses used by rating agencies, by donors, funders, management, and everybody else who can read financial statements. Therefore, we're going to discuss overall expenses presentation on financial statements for nonprofit organizations. So first of all, to remind you, we will be talking about accrual method of accounting. Accrual method of accounting is required method based on the GAAP, General Accepted Accounting Principles. And under accrual method of accounting, expenses have to be recognized when they've been incurred. Not when the cash was paid, not when the nonprofit received invoice. It's like when nonprofit incurred expenses. To understand why GAAP require accrual method of accounting and recognition of expenses based on the fact when they were incurred, it's good to remember that main principle of accounting is matching. Matching means that expenses and financial statements have to match the effort that management and nonprofit puts in operation with the presentation of the financial statements. So only after expense was incurred, it means that some effort was done, some activity was performed, therefore expense should be recognized. Just a good trick to remember why expenses are recognized on the accrual method of accounting. Expenses needs to be tracked by nonprofit organizations by for 2 different purposes. Expenses are recorded based on natural purpose and by function. Both of them very important and serve different purposes. A chart of accounts in accounting system have to represent natural type of expenses, meaning that the accounts needs to be named advertising, salary, wages, payroll tax, benefits, utilities, travel, etc. Names of the chart of accounts name expenses such as other, miscellaneous, or reimbursable, not a very good name because they do not represent the nature of expense. It's very vague. It's not sufficient for readers to understand what kind of expenses are included in this kind of account. Let's just take a look at reimbursable expenses. What can be reimbursed? Nonprofit can reimburse for supplies, nonprofit can reimburse for travel, for advertisement. Any expense can be reimbursed. Therefore, to have a name reimbursable expense, it's not natural type. Nonprofit should not create an account called reimbursable expenses. They need to be split in various natural type of expenses. How many expense accounts nonprofit should have? And it's a very good question that a lot of nonprofits struggle with. Accounting system is used by nonprofits for various purposes. For reporting expenses to funders, for management purposes, for budgeting, for creating reports for the board, and also for financial statements. Because that accounting tool is used for various purposes, sometimes management tends to influence accounting and create as many expense accounts as possible so the management can see on the face of financial statements all the details are needed for those various purposes. And that could be absolutely okay, but sometimes number of expense accounts can reach the point that trial balance or chart of accounts becomes very difficult to manage. Too many expense accounts can create a chaos and can create much more mistakes than provide benefits to the managed expenses. Therefore, it's advisable for nonprofits to revisit its chart of accounts specifically related to expenses and see if there are any repetitive expense accounts exist. If they can be somehow summarized and make it more manageable. Accounting systems are designed in a way that if accountants drill inside accounts, we can extract the information that management needs. It does not need to be on the face of financial statements that for each detail transaction we need to create a separate account. Also, a good idea to remember materiality. Even if nonprofit incurred some unique expense, but it's very immaterial, probably it does not deserve to have its own general ledger account. Therefore, as a rule of thumb, I would advise to consider that small nonprofits should not have more than 20 expense accounts. Larger nonprofits may be between 25 and 50 expense accounts. Anything more than that will create more mistakes and make tracking expenses more difficult. As we mentioned before, expenses needs to be recorded as an expense, not when expense was paid, not when invoice was paid, but when expense incurred. If expense was paid or invoice was paid for the services that will be provided in future, this is a payment needs to be recorded as a prepaid expense, which is asset on a balance sheet. Typical prepaid expenses are insurance that paid for future periods. Also rent very often is prepaid for the next months. So for example, if the organization year end is December 31st and on December 30th, organization paid rent for the next months of January, that amount will need to be recorded as a prepaid expense, which is asset, debit prepaid expense, and credit cash. And in January, that prepaid expense should be removed from prepaid to real expense rent. So we will credit prepaid and debit rent expense. Other type of expenses are depreciation expense, which are not based on real payment. And depreciation expense is more allocation of the cost of the asset that was acquired sometime before. Depreciation expense typically needs to be recorded monthly. However, if depreciation and fixed assets are not material amounts for nonprofit organization, they can be recorded annually. And it's just accounting transaction. There are no cash outflow. Therefore, bookkeepers need to remember to keep track of the depreciation and record the depreciation expense at the end of the period, either monthly, quarterly, or annually. Another type of expenses are grants that paid out by nonprofits either to other nonprofits, to participants, to members, and maybe some scholarships. When these type of expenses should be recorded as expenses. Again, going back to our accrual method of accounting, they should not be recorded as expense when they paid, but when they unconditionally promised. If you remember our previous snaps, when we were talking about accounting for contributions, we were talking that revenue is recognized when it's unconditionally promised. In the same way, when grants paid out by nonprofit, they have to be recognized as expense when they unconditionally promised either to the party that's going to be recipient of that grant. When that unconditional event take place depends on the policies and procedures that nonprofit has. Some nonprofits have board meetings when they do approve promises and grants to be paid out to other parties. And that moment when the board approves, grant becomes expense to nonprofit organization. Some nonprofits have policy and procedures when management just decide and they say that we approve all the grants on July 1st. And they do document and send letters to those recipients of the grants. So there should be some approval point inside nonprofit when they make this promise, an unconditional promise to the third parties that they're going to be recipient of the grants, scholarship, etc. Just a reminder that promise has to be unconditional. If nonprofits make a conditional promise, nothing is recorded. And conditional promise would be something if nonprofit says, we're going to give you a grant for 10 years, $10,000 each year, if we will have sufficient amount of fund to sustain that promise. This if is a condition, therefore no expense will be recognized until the actually grant is paid out. So another type of expenses paid through intermediaries. Expenses recorded as expense regardless whether cash came out of nonprofit account. Let me give you an example. City of San Francisco gave a grant to nonprofit to buy a building. Nonprofit secured the building and City of San Francisco paid for the building directly to the escrow. Nonprofit did not receive funds through their bank account, but as a result of the transaction, nonprofit received the building. For nonprofit, even though there were absolutely no funds that came through the nonprofit bank account, nonprofit needs to record grant revenue from State of San Francisco and building. This if it was purchased building. if there were some other expenses paid through intermediaries, like escrow in this case, this expense still need to be recorded. Therefore, it doesn't matter how cash flows. If the nonprofit incurred expense, it needs to be recorded as expense. And the last part that I want to talk about is netting expenses with revenue accounts. GAAP does not allow netting expenses against revenue. If organization, for example, had a special event, had revenue and expenses related to special event, they need to be recorded separately. Separate revenue, separate expenses. They're gross. We should not net revenue with expenses. The only type of income and expense that allowed to be net, it's investment return. GAAP do ask us to net revenue from investment activities, with expenses, and record as a net. Everything else needs to be recorded as gross. And that concludes our NAP number 5, overview of expenses for nonprofit organization. In the next NAP, we're going to talk about statement of functional expenses, or SFE. Thank you so much. Thank you for being here with me, and see you for NAP number 6.